There is a grey door insurers hate. It hangs in millions of American homes, and until what sits behind it is gone, many carriers refuse the whole house. Behind that door sits a breaker panel stamped Federal Pacific Electric, sold nationwide with a promise of protection that a courtroom would eventually call a knowing lie. Builders installed these panels in roughly 25 million homes between the 50s and the late 80s. Suburbs, ranches, split levels, entire neighborhoods wired through one design. Odds are you have walked right past one this week, and this episode shows you exactly how to know, in under a minute, whether one is yours. A circuit breaker has one job. When a wire overloads, it trips, cutting power before the copper glows. It is the guard standing between you and fire. Pendant testing of these breakers found something chilling. At a modest overload, more than a quarter of them simply refused to trip. The guard stayed fast asleep. Hit the same breaker with repeated surges and the refusal rate climbs toward 2/3, while one engineer's bench tests failed roughly half of every unit examined. A breaker that will not trip is not a dormant part. It is a promise that breaks exactly once, on the worst night your house will ever have. Fire data has attributed roughly 2,800 house fires a year to failures of this one panel design, quietly compounding across the housing stock for decades. The human ledger reads 13 deaths in a typical year, and the property ledger $40 million, from a component homeowners never touch and rarely think about. Most owners learn none of this from the panel itself. It hums along for decades, passing every ordinary day, hiding a defect that only emergencies can reveal. So a federal safety agency finally stepped in, and what happened next explains why this panel is still quietly hanging in millions of American basements right now. The Consumer Product Safety Commission opened a formal investigation and spent 2 full years testing, documenting, and confirming that the failure numbers were not merely a rumor. Then in 1983, the agency terminated the entire investigation, not because the panels were demonstrated safe, but because continuing the proof demanded federal money nobody possessed. Read the closing statement carefully, and the words are startling. The commission never declared these breakers safe. It simply stopped looking, and everyone else assumed the rest. No recall was ever issued, not that year, not the next, not in the 4 decades since. The panels stayed on the walls and kept their secret. Every other dangerous product you can name got pulled from shelves. This one could not be pulled because it was already bolted deep inside the houses themselves. 2 decades afterward, a New Jersey state courtroom finally declared openly what the failure data had whispered, and the written decision employed a word regulators never dared. The court found the company knowingly and purposefully distributed breakers that were never tested to the standards printed on their own packaging. The labels were pure fiction. That little certification mark homeowners trusted blindly for 30 years was, for many of these breakers, a claim the company had faked its own way past entirely. The ruling entitled affected owners to triple damages, but the company was already long gone, dissolved, sold, restructured, leaving nobody standing behind those 25 million installations. So no recall, no manufacturer, no compensation whatsoever. The only institutions left holding the risk were the ones that must write checks when houses burn, the insurers. Insurance companies read the identical failure studies you just heard, then calculated the arithmetic on 2,800 fires annually, and reached a very quiet business decision. Many carriers now decline new policies outright when an inspection finds this panel, and others simply refuse to renew the moment one shows up in routine underwriting. Homeowners usually discover this at the worst possible moment: a closing, a renewal notice, a new carrier's inspector walking straight down to the basement with a flashlight. And here is the familiar trap from our last episode again. Replacing the panel counts as maintenance, so insurance will almost never pay for the fix itself. Keep the panel and you risk a denied claim after a fire. Replace it and you pay out of pocket. The company's mistake became your personal bill. The housing market certainly noticed this too. Home inspectors now flag the panel by name, and one flagged line instantly changes the entire temperature of a negotiation. Buyers hear the words fire hazard and uninsurable in the same sentence, then quietly subtract the replacement, the hassle, and a safety premium, or walk away entirely. Sellers who knew and said nothing face a nastier problem, because non-disclosure of a known electrical hazard is the kind of thing post-sale lawsuits are made of. Which brings us to your own house. Checking requires well under a minute, demands absolutely no tools, and you never touch a single wire throughout the entire process. Find the plain grey metal box, garage, basement, hallway, closet, and open the outer door. That part is meant to be opened. The inner cover is not. Look for the names printed on the label or door. Federal Pacific, its longer electric variant, or Stab-Lok. Any one of them means you have found it. There is also a quick visual tell. Long rows of breaker switches with bright orange or red tips, a color scheme most other manufacturers never widely used. While the door is open, briefly acknowledge the lesser-known sibling villain. Panels stamped Zinsco carry their own documented failure history and their own entirely separate insurance blacklist. If the label announces anything different, the major modern manufacturers close the panel door and exhale slowly. Your guard is standing, and this episode remains only a story. But if you found the name, do not panic and do not touch the breakers. The panel is merely an unreliable guard. It is not a bomb. Call a licensed electrician for a replacement quote and say the exact brand name over the phone. Most crews will know precisely what they are walking into. A typical replacement runs $2,000 to $4,000 installed, more where local codes force much wider upgrades, and it usually finishes inside a single working day. Compare that bill to the alternative ledger: a denied fire claim, an uninsurable address, a collapsed sale, and a buyer pool that keeps on walking straight past. In a series about upgrades that quietly subtract value, this is the inversion, the unglamorous swap that adds back insurability, closability, and honest sleep all at once. No countertop will ever return value like this. A four-figure fix protecting your largest asset from the single loss insurance may flatly refuse to ever cover. And the schedule is forgiving. Nothing requires a panic replacement this weekend. It requires one calm decision this month, settled before an underwriter quietly decides for you. Step back and the whole story slowly sharpens into one deeply uncomfortable shape. The recall that never came did not disappear. It just changed owners along the way. The manufacturer escaped it, the regulator shelved it, and the insurers priced their way around it, which quietly left the recall sitting in your own basement unfunded. So the genuine recall is finally happening anyway, distributed invisibly across closings, renewals and inspections, administered not by any federal regulator but by ordinary paperwork, 40 years late. The grey door from our opening is probably within about 50 feet of you right now. Opening it costs nothing, and knowing beats hoping every single time. Next episode, the grey plastic pipe that triggered one of the largest class actions in American history, and how to spot it under your own kitchen sink tonight.